All right, let's talk about one of the biggest, most persistent ideas in investing. It's this notion that you can get paid, literally get free money, just for owning a stock. Yep, we're diving deep into dividends today, and we're going to tear apart this idea to see if it's really the golden ticket everyone thinks it is. I mean, you've got to admit the idea is so appealing, right? You buy a stock, you sit back, and a company just sends you cash. It feels like you found the ultimate cheat code for your finances, a way to get paid for doing basically nothing. And, that's exactly why so many people get hooked on this idea.
And that's the dream, isn't it? You own a little piece of a company, and like magic, a steady stream of cash just starts showing up in your account. It's pretty much the definition of passive income. But you know what they say, whenever something sounds that good, you really have to start asking some questions.
So where is this money actually coming from? Is the company just firing up a printing press in the back room to create a special bonus for you? Is it literally being created out of thin air? Because honestly, the answer to that question changes absolutely everything about how you should think about dividends.
Okay, so here's the big reveal. The fundamental truth that turns this whole idea on its head. A dividend is not a bonus. It is not new money. It's simply a transfer of value. The company is taking money out of its own pocket and putting it into your pocket. That's it. And understanding that one little distinction is the key to it all. And it brings us to a really important concept called total return. So total return, this is the only number that really tells you the full story of how your investment is doing. It doesn't just look at one piece of the puzzle. It includes everything. The change in the stock's price, what we call capital gains, and any cash you get, like dividends. You need both to see what's really going on. Let me just walk you through a super simple example to make this crystal clear.
Okay, so let's imagine you own one single share of a company, and that share is worth exactly $100. So what's the total value of your investment? $100. Nice and easy, right?
Now here comes the fun part. The company announces it's paying out a $2 dividend. That $2 in cash is now headed right for your account. This is the moment where you think, cha-ching, free money. But hold on, watch what happens next.
And this is the part that almost everybody misses. It's not a secret, it's just how markets work. When that dividend gets paid out, the stock's price automatically drops by the exact same amount. So your $100 stock instantly becomes a $98 stock. Why? Well, think about it. The company just gave away $2 per share. That cash isn't in the company's bank account anymore. It's in yours. The company is now worth a little bit less. So let's just do the quick math here. You've got your stock, which is now worth $98. And you've got $2 in fresh cash sitting in your account. What do you get when you add them together? You're still at exactly $100. Your net worth hasn't changed by a single penny. No magic.
So here's the absolute bottom line. Getting a dividend is literally like taking a $20 bill out of your left pocket and putting it in your right pocket. Are you any richer? Nope. You've just moved your own money around. You traded a little stock value for the same amount of cash. Now, that's not to say dividends are bad. They can be a great way to force some savings or generate an income stream. The danger is not understanding that it isn't new money, because when you don't get that, you can walk right into a pretty nasty trap.
And that trap has a fantastic name that really paints a picture. You have got to beware of something called high-yield slop. Yeah, it sounds pretty gross, and believe me, for your portfolio, it can be.
The analogy here is just perfect. You know how some food companies create protein slop? They pack a product with cheap, low-quality fillers just to make the protein number on the label look really high. Well, it's the exact same thing in investing. High-yield slop is when a struggling company dangles a huge dividend in front of you, hoping you'll get so focused on that big, juicy number that you won't notice the business itself is in trouble.
So really, it all comes down to this choice. Are you doing healthy investing, where you focus on a strong company with real growth prospects, the total return? Or are you just chasing the high-yield slop, getting mesmerized by one flashy number? The big risk is that you'll get, say, an 8% dividend while the stock price is falling 15% a year. You're still losing money. That is a classic value trap.
So, what's the smarter takeaway from all this? First, and most importantly, dividends are not free money. It's just you paying yourself with your own investment. Second, because of that, you have to focus on the total return, the whole shebang, not just the yield. Third, remember that a crazy high yield can actually be a huge red flag, not an invitation to buy. And finally, and this is always true, the quality of the actual business is what matters more than anything else.
Hey, if this explainer helped clear things up for you, it would be awesome if you could just take a second and hit that like button. And of course, make sure you're subscribed so you don't miss out the next time we start busting another one of these big investing myths.
Okay, and this part is really important. Please remember, this is just an explainer. It's a way to think about the market. It is absolutely not financial advice. You've always got to do your own homework and make the decisions that are right for your own situation.
So, to wrap this up, I want to hear from you. We've just deconstructed a massive myth. But what's the biggest, or maybe even the silliest myth about dividend investing that you've ever come across? Drop it down in the comments below. I'm really curious to see what you've all heard out there. Thanks for watching.